Imagine this. It's Friday afternoon. Your paycheck just hit your bank account. You're grabbing coffee before heading home when your phone buzzes. Your coworker leans over your desk and says, "Dude, did you see Nvidia today?" Another coworker jumps in. "My cousin made $18,000 in just 3 weeks buying one AI stock." 5 minutes later, someone else says they're buying crypto again because, this time it's different. Suddenly, you feel behind. You start wondering, am I missing out? Should I buy something before it's too late? Everyone else seems to know what they're doing except me. So you open your investing app. You don't research. You don't have a plan. You just buy. Because everyone else is buying. Fast forward 3 months. The stock drops 37%. Financial news says the market is uncertain. Your portfolio is bleeding red. Now those same coworkers? They're strangely quiet. The cousin who supposedly made 18 grand? Turns out, he forgot to mention the $11,000 he lost the year before. Sound familiar? Here's the uncomfortable truth. Most people don't lose money because they're unintelligent. They lose money because they're human. Investing isn't a battle against Wall Street. It isn't a battle against hedge funds. It isn't even a battle against inflation. It's a battle against the person staring back at you in the mirror every morning. Because your emotions, your habits, your impatience, your ego, can quietly destroy decades of wealth without you even realizing it. And that's exactly what we're talking about today. The 7 deadly sins of investing. These aren't illegal mistakes. They're not complicated accounting tricks. They're everyday behaviors that quietly keep millions of Americans from ever becoming financially free. Some of these mistakes look smart. Some feel completely logical. Some are even praised on social media. But over time, they can cost hundreds of thousands, sometimes even millions, of dollars. By the end of this video, you'll know exactly how to spot these investing traps before they wreck your financial future. I'm Della, and on this channel, we simplify investing, personal finance, and wealth building so you can make smarter financial decisions without needing a finance degree. If that sounds useful, consider subscribing. Now, let's expose the first, and probably the most common, deadly investing sin. Before we begin, here's something that surprises a lot of people. The biggest investing mistakes usually don't happen during a market crash. They happen during normal life, on an ordinary Tuesday, while you're scrolling through social media, watching YouTube, listening to friends at work, reading headlines, or checking your phone before bed. Nobody wakes up planning to sabotage their retirement. Yet millions do it little by little. Think about it. You probably spend weeks comparing televisions, days researching a new car, hours reading restaurant reviews before trying somewhere new. But then, someone on TikTok says, "This stock is going to the moon." And suddenly, thousands of dollars disappear from your savings account into an investment you've researched for less than 10 minutes. That's not investing. That's gambling dressed up in nicer clothes. The financial industry often makes investing sound incredibly complicated. Fancy charts, economic forecasts, interest rate predictions, political news, Federal Reserve meetings, inflation reports, GDP numbers, corporate earnings. It feels overwhelming. So people assume successful investors must be financial geniuses. But history tells a different story. Many successful investors didn't outperform because they were smarter. They outperformed because they consistently avoided making the biggest mistakes. That's an important distinction. Building wealth isn't always about making brilliant decisions. More often, it's about avoiding disastrous ones. Imagine driving across the country. You don't need Formula 1 driving skills. You simply need to avoid driving into a ditch. Investing works the same way. Every major mistake compounds. Not just financially, but emotionally. One bad investment creates fear. Fear creates hesitation. Hesitation causes missed opportunities. Missed opportunities delay retirement. Delayed retirement creates stress. Stress affects every part of your financial life. That's why today's video isn't about finding the next $1 million stock. It's about protecting yourself from the behaviors that quietly steal your future. Because avoiding catastrophic mistakes often matters more than finding spectacular winners. And that brings us to the very first deadly sin. One that's responsible for countless financial regrets. Sin number 1, chasing what's hot. Let's be honest. Almost everyone has done this. You hear about a stock. Not because you researched it. Not because you understand the business. But because everyone else won't stop talking about it. Maybe it's AI. Maybe electric vehicles. Maybe cryptocurrency. Maybe a biotech company promising the next medical breakthrough. Whatever the trend is, it suddenly feels impossible to ignore. You open YouTube. Every thumbnail says, "This stock will double." Open Instagram. Financial influencers are posting screenshots of massive gains. Open Reddit. Thousands of comments insist this investment is free money. Even your barber has an opinion. When your Uber driver starts recommending stocks, that's usually a sign excitement has already spread far and wide. And here's what happens psychologically. Your brain doesn't think, is this investment actually worth buying? Instead, it asks, what if everyone gets rich except me? That's called FOMO. The fear of missing out. FOMO is incredibly powerful because humans evolved to follow the crowd. Thousands of years ago, sticking with the group helped people survive. Today, that same instinct can hurt your portfolio. By the time an investment becomes the hottest topic at family dinners, office conversations, and social media feeds, much of the easy money has often already been made. You're not buying early. You're arriving after the excitement has pushed prices higher. History has shown this pattern again and again. The dot-com bubble. The housing boom. Meme stocks. Cryptomanias. Different assets. Same psychology. People rush in because prices are rising. Then panic when prices fall. Notice something interesting. People rarely ask, should I buy this company? They ask, is it too late? That question reveals something important. They're focused on price movement, not business quality. Great investors don't buy something simply because it's going up. They ask different questions. What does this company actually do? How does it make money? Does it have a competitive advantage? Can it still grow over the next decade? Would I feel comfortable owning it if the stock market closed for 5 years? Those questions aren't exciting. They won't go viral. But they can help you make far better decisions than chasing whatever is trending this week. Think of investing like buying a house. If every home in your neighborhood suddenly doubled in price overnight, would you rush to buy the most expensive one just because everyone else was? Probably not. You'd want to know whether the house was actually worth the price. Stocks deserve the same discipline. One of the most expensive investing habits is confusing popularity with value. A company can be excellent and still be overpriced. Another company can be boring and still be an outstanding investment. The market doesn't reward excitement. It rewards patience, discipline, and time. That's why your first defense against this deadly sin is simple. Whenever you feel an overwhelming urge to buy because everyone else is buying, pause. Wait at least 24 hours. Research the business. Understand how it makes money. Know the risks. And ask yourself one simple question. If nobody on social media were talking about this today, would I still want to own it? If the answer is no, you're probably chasing hype instead of building wealth. Deadly sin number 2, trying to time the market. Imagine Sarah. She had $20,000 ready to invest. But she kept saying, I'll wait until the market crashes. 6 months passed. The market kept climbing. Then it finally dropped. 10%. Sarah felt smart. It'll fall another 20%, she thought. Instead, the market rebounded and hit new highs. She never invested. The biggest cost wasn't the crash she avoided. It was the years of growth she missed. Here's the truth. Nobody, not Wall Street, not YouTubers, not economists, can consistently predict market tops and bottoms. Instead of timing the market, spend time in the market. Invest consistently through dollar cost averaging. Some months you'll buy high. Some months you'll buy low. Over decades, it smooths out and lets compounding do the heavy lifting. Rule: stop predicting. Start participating. Deadly sin number 3, investing without a plan. Imagine driving across America with no destination and no GPS. Eventually, you'll end up somewhere. But probably not where you wanted. That's exactly how many people invest. They buy a stock because a friend mentioned it. Sell because of bad news. Buy crypto next month. Then ETFs. Then dividend stocks. They're constantly changing direction. A real investor starts with a plan. Ask yourself, why am I investing? Retirement? Buying a home? Financial freedom? Then choose investments that match that goal. A simple strategy followed for 30 years beats a perfect strategy abandoned after 6 months. Rule: build your plan before you build your portfolio. Deadly sin number 4, letting emotions make decisions. The market drops 15%. Your portfolio turns bright red. Suddenly every headline screams recession. Sell before it's too late. Fear takes over. You sell. 6 months later, the market has recovered, and you're buying back at higher prices. That's the cycle. People buy because of greed and sell because of fear. Successful investors reverse it. They stay calm when others panic, because volatility isn't the enemy. Emotional decisions are. Remember, the stock market transfers money from the impatient to the patient. Rule: never make investing decisions based on today's headlines. Deadly sin number 5, ignoring diversification. Imagine putting your entire life savings into one company. It sounds crazy. Yet people do it every day. One lawsuit, one bad earnings report, one CEO scandal, and years of savings can disappear overnight. Diversification isn't about lowering returns. It's about lowering the chance that one mistake ruins your future. Own different companies, different industries, different asset types. Never let one investment decide your financial future. As the saying goes, don't put all your eggs in one basket. Because if that basket falls, everything falls with it. Deadly sin number 6, confusing saving with investing. Let me ask you something. If you left $10,000 sitting in a savings account for the next 20 years, would you be building wealth? Not really. You'd be preserving money, not growing it. A savings account has one job: protect your cash. Investing has a different job: grow your purchasing power over time. Too many Americans feel financially responsible because they save every paycheck. And saving is important. Your emergency fund should absolutely stay in a safe, accessible account. But once that emergency fund is fully funded, letting the rest of your money sit in cash can quietly cost you. Why? Because inflation keeps working, even when your money isn't. If inflation averages around 3% a year and your cash earns less than that after taxes, your money slowly loses buying power. That's why long-term goals, like retirement, building wealth, or leaving a legacy, usually require investing, not just saving. Think of it this way. Saving is parking your car. Investing is driving it toward your destination. Both have a purpose. Just don't confuse one for the other. Rule: save for short-term needs. Invest for long-term dreams. Deadly sin number 7, waiting for the perfect time. This is the sneakiest investing mistake of all. It sounds responsible. I'll invest after the election. I'll wait until interest rates come down. I'll start once I make more money. Next year will be a better time. Months turn into years. Years turn into decades. And the perfect time never arrives. Here's the reality. There will always be uncertainty. A recession. Inflation. A new war. Political drama. Market volatility. If you wait for the world to feel completely safe, you'll wait forever. Successful investors don't invest because everything looks perfect. They invest because they know time matters more than perfect timing. Every year you delay is one less year your money has to compound. And compounding doesn't just grow your money. It grows time itself. The earlier you start, the harder your money works for you. The best day to start investing was years ago. The second best day is today. Rule: progress beats perfection. Start before you feel ready. Final thoughts. So let's recap the 7 deadly sins of investing. Chasing what's hot. Trying to time the market. Investing without a plan. Letting emotions make decisions. Ignoring diversification. Confusing saving with investing. Waiting for the perfect time. Notice something? None of these are about finding the next Tesla, Nvidia, or the next 10x stock. They're about avoiding behaviors that quietly destroy wealth. Because investing isn't about being the smartest person in the room. It's about being disciplined when everyone else is emotional, patient when everyone else is impatient, consistent when everyone else is distracted. You don't need to predict the future. You need a plan and the discipline to stick with it. Build good habits. Keep investing consistently. Ignore the daily noise. And let time become your greatest financial partner. Because in investing, the biggest winners aren't usually the ones who make the flashiest moves. They're the ones who simply make the fewest mistakes. If you can avoid these 7 deadly sins, you'll already be ahead of millions of investors chasing shortcuts instead of building lasting wealth. And years from now, your future self will thank you for the decisions you started making today. Key truth about wealth nobody talks about. Before we wrap up this video, there's one more lesson that's even more important than all 7 investing sins combined. Because here's something I've noticed after studying successful investors for years. The people who build real wealth don't necessarily make more brilliant decisions than everyone else. They simply make fewer stupid decisions. That might sound obvious, but think about it. When most people imagine becoming wealthy, they picture someone constantly making winning trades. Buying the perfect stock, selling at exactly the right moment, finding the next apple before everyone else. But that's not how most fortunes are built. In reality, wealth usually grows quietly, almost boringly, month after month, year after year, without headlines, without excitement, without trying to impress anyone. The media loves extraordinary success stories. The college student who turned $5,000 into $1 million. The investor who picked the next Tesla. The trader who doubled his money in 6 months. Those stories get millions of views because they're exciting. But they also create a dangerous illusion. They make us believe that extraordinary wealth requires extraordinary moves. Most of the time, it doesn't. Instead, it requires ordinary decisions repeated for an extraordinarily long time. Imagine 2 friends. Jake and Michael both start investing at age 25. Jake spends every evening chasing the next hot investment. He jumps from AI stocks, to crypto, to biotech, to meme stocks, to options trading. Every year he's searching for the next big thing. Michael does something much less exciting. Every payday, he automatically invests into a diversified portfolio. No predictions. No panic. No drama. Just consistency. Fast forward 30 years. Who do you think has a better chance of retiring comfortably? The answer surprises a lot of people. Not because Michael found better investments, but because he stayed invested while Jake kept starting over. The market rewards consistency far more often than brilliance. Investing is more like farming than gambling. One of the biggest mindset shifts you can make is changing how you think about investing. Most people treat investing like a casino. They expect immediate results. If a stock doesn't go up within a month, they think they made a mistake. But investing isn't gambling. It's farming. A farmer doesn't plant seeds on Monday and dig them up on Friday to check if they're growing. Imagine how ridiculous that would be. Every week, digging up the seed, looking for progress, planting it again somewhere else. Nothing would ever grow. Yet millions of investors do exactly that. They buy, check the price every hour, sell after a small drop, buy something else, then repeat the cycle. Constant activity feels productive. But in investing, activity and progress are 2 very different things. Sometimes the smartest financial decision you'll make all year is absolutely nothing. Your biggest investment isn't money. Here's another perspective that rarely gets talked about. People think their biggest investment is dollars. It's not. It's time. Money can be replaced. Time can't. If you lose $10,000, you can earn it again. If you waste 10 years waiting for the perfect opportunity, those years are gone forever. That's why starting early matters so much. Not because you invest more money, but because you give your money more years to work. Think of every dollar you invest as an employee. On day 1, that employee starts working for you. Then that employee earns profits. Those profits become new employees, who also start working. Eventually, your money begins producing more money than your paycheck. That's the point where wealth starts accelerating. Not because you suddenly became smarter, but because compounding finally had enough time to do its job. Most people quit just before that acceleration happens. They expect instant results from a system designed to reward patience. Stop measuring success the wrong way. Many investors judge success by one question. How much did my portfolio make this month? That's the wrong scoreboard. A better question is, did I follow my investing plan? Because you can't control what the market does tomorrow. You can control whether you keep investing, whether you stay diversified, whether you avoid emotional decisions, whether you continue learning. Focus on the process. The results usually follow. Professional athletes don't become champions by obsessing over the scoreboard every minute. They master the fundamentals. Investing works exactly the same way. Build great habits. The wealth comes later. The rich don't think differently because they're rich. They become rich because they eventually learn to think differently. They stopped chasing shortcuts. They stopped comparing themselves to everyone else. They stopped treating investing like entertainment. Instead, they started treating it like ownership. When you buy shares of a great business, you're becoming a tiny owner of that company. You're not buying a lottery ticket. You're buying a piece of something designed to create value over many years. That simple shift in perspective changes everything. Suddenly, daily price swings become less important, headlines become less frightening, and patience becomes much easier. Because you're no longer asking, will this stock go up tomorrow? You're asking, will this business likely be stronger 10 years from now? Those are two completely different mindsets. And one of them has created far more wealth than the other. Before you go, I want you to remember one thing. The biggest threat to your financial future isn't inflation. It isn't a recession. It isn't the Federal Reserve. It isn't even a stock market crash. It's making emotional decisions over and over again. Wealth isn't built in one incredible trade. It's built through hundreds of ordinary, disciplined decisions made consistently over time. Every paycheck. Every month. Every year. That's how everyday Americans become millionaires, not by getting lucky, but by staying invested, keeping costs low, diversifying, and letting compound growth do the heavy lifting. So the next time you feel tempted to chase a hot stock, or panic because the market is falling, or tell yourself you'll start next year, come back to these 7 deadly sins. Ask yourself, am I making this decision based on a solid plan, or on emotion? That one question could save you thousands, or even hundreds of thousands of dollars over your investing lifetime. Quick challenge. Which of these 7 investing sins have you struggled with the most? Chasing hot stocks? Timing the market? Investing without a plan? Emotional investing? Lack of diversification? Saving instead of investing? Waiting too long to start? Let me know in the comments. I'd love to hear your experience, and your story might help someone else avoid the same mistake. If you found this video helpful, give it a thumbs up and subscribe because every week we break down investing, personal finance, and wealth building into simple, practical lessons anyone can understand. Thanks for watching. I'm Della, and I'll see you in the next video.